Stock markets are breaking records. The S&P 500 sits at near all-time highs. The FTSE 100 has climbed above 9,000 for the first time in history. At a glance, the story seems triumphant. But beneath the headlines, concern is spreading. Investors, households, and businesses are not celebrating with the same enthusiasm. They see cracks forming in the system, and those cracks matter. According to Gallup, 60% of investors are concerned about recent stock market volatility. Gallup also states, in a year of stock values reaching record or near record highs early on, only to plummet in March and April before recovering in May and June, 6 in 10 US investors expressed concern about market volatility, including 28% who are very concerned. Most investors foresee volatility persisting through 2025 and believe the worst is still to come rather than behind us. A Charles Schwab survey conducted in July 2025 echoes that anxiety, stating that over half, 57% of traders, believe the market's currently overvalued. Only 24% feel a high degree of conviction in their 3-month outlook, and more than 3/4, 85%, noted that they expect volatility to either stay the same, 36%, or increase, 49%, through the remainder of 2025. So what explains this disconnect? Why is everyone so worried about stocks right now? Markets are being driven higher by optimism, not by earnings. Corporate profits have been sluggish, squeezed by rising costs and weakening consumer demand, yet valuations keep inflating. The skyscraper analogy fits pretty well. Impressive on the outside, but the base is unsteady. When fundamentals don't support the price, corrections are inevitable. The story of 2025 is not that companies are outperforming, but that markets are running ahead of reality. Optimism is not new. In 1929, 1987, 2000, 2008, even 2020, investors believed they had entered a new era where the rules had changed. They hadn't. The cycle's familiar. Hype builds, valuations stretch, reality intrudes, and markets crash. Every time, millions of people are caught by surprise. Each time, analysts point out the warning signs in advance. The lesson is not that markets rise forever, it's that they always correct, often brutally. Trade policy is now another layer of uncertainty. Tariffs are, in effect, sales taxes on imports. They raise consumer prices, reduce global trade, and hit confidence. When households pay more for essentials, they cut back on discretionary spending. When businesses see supply chains strained and export markets shrinking, they hold back on investment. These are the quiet drags that eventually show up in corporate earnings and the broader economy. Artificial intelligence is the hottest theme in global markets. Trillions of dollars in valuation are riding on a handful of tech giants leading the AI charge. But parallels to the dot-com era are growing stronger by the day. Back then it was internet companies with no profits. Today it's AI companies with extraordinary expectations to deliver growth. If results fail to match the hype, the bubble could deflate quickly, dragging much of the market down with it. In the UK, the picture looks particularly fragile. The IOD Directors' Economic Confidence Index, which measures business leader optimism in prospects for the UK economy, fell to -72 in July 2025 from -53 in June. This exceeds the previous record low of -69 in April 2020 and marks the lowest reading of the index since its introduction in July 2016. Business leader confidence in their own organisations also fell to -9 in July 2025 from +3 in June. This is the second lowest reading of this indicator since its introduction in July 2016. In other words, confidence hasn't just slipped, it's collapsed to levels worse than those seen during the height of the pandemic. It's not just a statistic, it's a signal from inside the economy. If people running businesses are not confident enough to invest or expand, then the market rally is out of step with reality. Business leaders are preparing for leaner times, not celebrating a boom. Look, the stock market is experiencing record highs. The FTSE 100, the UK's leading stock index, has officially reached a new peak. Yet confidence among business leaders inside the UK economy has collapsed. The disconnect is striking. Global-facing companies are boosting the index, while those running businesses on the ground see leaner times ahead. This pattern is not unique to Britain. In the United States, the S&P 500 surge has been led overwhelmingly by a handful of mega-cap names. Nvidia, Microsoft, Apple, Amazon and Alphabet now make up over a quarter of the entire index's weight. Nvidia alone has added more than $1 trillion in market value in 2025, driven by AI euphoria. Strip those giants out and the broader S&P 500 looks far weaker. According to FactSet data, earnings across the remaining companies are projected to grow less than 2% this year, barely keeping pace with inflation. Meanwhile, consumer-facing firms like Target and Macy's have reported declining sales as households pull back, and smaller businesses continue to struggle with borrowing costs at multi-decade highs. It's the same paradox. Indices flash record highs, yet the underlying economy shows strain, and leaders in both boardrooms and households are bracing for impact. And that unease is not confined to executives, it's spreading into families where ordinary people feel the pressure most directly. The anxiety is not just in boardrooms, it's in households too. Families face rising rents, higher food bills, and shrinking disposable income. Many are cutting luxuries, delaying essential purchases, and in some cases, falling back on debt just to stay afloat. This matters because consumer spending drives economic growth. When households stop spending, corporate profits fall and stock market optimism looks hollow. Debt is the fragile prop holding up today's economy. Globally, the figure has reached over $324 trillion. Governments are borrowing to fund deficits, corporations are borrowing to fund buybacks and expansions, households are borrowing to cover everyday costs. Debt can extend the cycle, but it cannot erase risk. At some point, obligations come due, repayments squeeze income, and the system weakens. Even the so-called safe havens are flashing red. UK gilts and US treasuries, the foundation of global financial systems, have shown signs of stress. These tremors echo the build-up to the 2008 crisis and the gilt market turmoil of 2022. When bond markets wobble, the ripple effects extend everywhere from pensions to mortgages to government finances. Equity markets may get the headlines, but bond markets are often where crises begin. The stock market can't stay disconnected forever. Either the fundamentals rise or the valuations fall. More often than not, it's the latter. The problem is that no one knows exactly where or when the correction will take place. No one has a crystal ball. It could arrive in a matter of months, sparked by a sudden shock, perhaps disappointing earnings, a geopolitical crisis, or a policy mistake. Or it could be years away, hidden behind a facade of momentum and optimism, slowly building pressure until one day the bubble bursts. That uncertainty is what makes markets so unnerving. History shows that corrections often feel impossible right up to the moment they happen. In 2007, commentators insisted that subprime mortgage problems were contained. Months later, the global financial system was on the brink of collapse. In early 2000, many believed internet stocks could only rise, only to see trillions in market value wiped out when reality intruded. Each generation thinks the cycle has changed, that somehow the rules are different this time, and yet the same story repeats. Prices run ahead of profits, confidence replaces caution, and eventually, gravity reasserts itself. The truth is that markets are reflections of human behaviour. They rise on a wave of enthusiasm and fall when fear takes over. Right now, enthusiasm is driving prices higher despite weak foundations. That does not guarantee an imminent crash, but it does guarantee risk. So, why is everyone worried about stocks right now? Because the risks are not theoretical, they're visible. Record highs without earnings, households under pressure, businesses lacking confidence, debt piling up, bond markets shaking, central banks cornered, inequality rising, political leaders at risk of repeating old mistakes. The signs are everywhere. Gallup's survey captures the mood. 73% of investors expect volatility to persist or worsen this year. Schwab's data adds to it. 57% of traders see the market as overvalued. That's why the concern is growing louder. Risk is high, stakes are higher, and caution is not pessimism, it's prudence. If you found this analysis helpful, make sure to subscribe for more clear breakdowns of the economy, markets, and global risks, so you're always informed before the headlines hit.